Welcome to another Five with Fitz. I'm, of course, Keith Fitz-Gerald. Thanks, as always, for joining me. You know, I'm looking at the trading screens today, and all I can think about is, oh, man, here we go again, right? All three indices are in the red as the selling continues. So what to do? Well, break out your buy list. You do have one of those things, right? We talk about that a lot. And then get to work. The path to profits is very clear, especially on days like today. What you need or may be lacking is simply the confidence that you're on the right track, even if Wall Street is seemingly off track. So to get that, I wrote something yesterday that I want you to reread. So please do that. Reread yesterday's Five with Fitz if you haven't already. I personally just did, and it's already helped me clear my head, even though I wrote the dang thing, and even though I've been doing this for decades. It's very, very important that you build up the mental stability to get through days like today. Always remember, if you are not investing when the chips are down, you will not be ahead of the game when they're up. There's a chart that I want you to look at in the written version of today's Five with Fitz, or on the archives if you'd prefer by my website. Go look at it. The markets have a very defined upward bias, and that's what you want to play to, even though the chips are down today, because you know they'll eventually be up later. That's how innovation works. So with that in mind, here's my playbook. Number one, do you own enough Tesla? Now, Tesla's annual meeting hits this afternoon, and with it, a vote on Uncle Elon's $1 trillion pay package. This is a big one. He's widely expected to get what he wants, but I learned a long time ago that the unexpected has a nasty way of serving up the main course when you least expect it. So I'm not in a hurry to buy more shares today until I know the results, but I am plenty content to own what I own meanwhile. You? Anyway, here's a trade idea to think about if you really are jonesing to do something. There is a lot of Tesla call option activity, meaning a bet that prices will rise to between $470 and $500 a share, which tells me that the bulls are trying to will prices higher. Now, I think that the higher probability choice would be selling covered calls, but the drawback, of course, in that instance with that tactic is the possibility of getting shares called away if Tesla really runs. I can also see buying deep in the money calls as a way of capitalizing on an upside moves using far less capital than buying an equivalent amount of shares would require. But at the end of the day, you know what? Simply adding a few shares, if that's what you want to do, is the simplest strategy and the simplest way to get on board, or at least get more on board. So let that sink in. Number two, Peloton is still the world's most expensive laundry hanger. Now, Peloton's back in the headlines, and not for anything you'd actually want to brag about. The company just recalled 833,000 Bike Plus units, as in every single one they've ever sold, after reports that the seat post apparently breaks mid-ride, which is sending a few poor souls flying. 2 injuries have been reported so far, but anecdotally scores more if what I hear is correct. Now, Wall Street fawned all over Peloton once upon a time. I wasn't having it, though. In fact, I told investors very specifically to avoid Peloton like the plague in 2020 when share prices peaked, quipping at the time that A, an iPad on a bike was not a breakthrough tech, and B, that the company's much vaunted bikes would likely soon be expensive laundry hangers or garage sale specials. Shares are down 95.9% from a high of $167.42 to just $6.86 as I type. Ouch. Now, my POV is this. Peloton is yet another poster child for what happens when hype outruns hardware. Once the pandemic halo faded, so did the business model. Just ask anybody who owned GoPro, which, by the way, has fallen 98.2% from an all-time high of $93.83 per share to just $170 as I record this. Now, Keith's investing tip in this department is very straightforward. Sometimes what you don't buy is every bit as important as what you do. And to that end, and in case you'd like some help in this department and you have no idea what to do next, you might enjoy becoming an OBAer. People tell me regularly that what they've learned about investing as part of One Bar Ahead has changed their lives dramatically. You can learn more by clicking on the link in the written version of the email or visiting my website if you want. Number 3 today, buy airlines now? All right, I haven't lost my marbles, but here's the situation. The FAA is cutting 10%, set to cut anyway, 10% of flights at 40 major airports because of the government shutdown. Now, not surprisingly, shares of the airlines are all down. American Airlines, Delta Airlines, United, the whole lot of them, right? Now, normally I won't touch airline stocks with a 10-foot pole, except under very specific circumstances. But I am tempted to make an exception in this case. Delta would be my choice. It's ranging, meaning it's bouncing between 60 and 50. It's just under 60 at the moment, but a fall to $50 could be attractive, at least a point. It sells cash secured puts or maybe buy some shares, which, both are favorite strategies of mine because they're high probability wins. So now, why Delta and not other airlines? Well, this is where it gets interesting. The company's rebranding itself into a premium lifestyle choice that goes beyond transportation. And I think it's working, which is why I expect that to show up in the numbers shortly, even if Delta's price doesn't necessarily reflect that at the moment. Now, anecdotally, I've chosen Delta over Alaska, which was long my domestic choice for the last few trips, and had a great experience. Better pricing, better cabins, better food, and yes, a better experience. Again, to repeat, I know it's repetitiously redundant. Alaska, are you listening? Number 4 today, Target, a turnaround or toast. Once upon a time, Target was the model for clean aisles, sharp design, and that mid-price magic that made many people joke it was Target. But not anymore. After 4 years of sluggish sales and a flood of customer complaints about messy stores, out-of-stock items, locked-up basics, the company's trying something new, or at least different. Target is shaking up its online fulfillment model, shifting ship-to-home orders to a smaller number of stores so that others can actually focus on, retailing. Imagine that. Now, the move is already in 36 markets, if what I understand is correct, and early results in Chicago show promise. Cleaner stores, fuller shelves, happier shoppers. It turns out employees really do better when they're not running a mini Amazon out of the stockroom. But now comes the real challenge. Foot traffic has been falling nearly every week since February. Customers say stores feel chaotic. Prices can't compete with Walmart, and Wall Street's patience is running thin. Now, I'll take Walmart over Target any day of the week. It may not be perfect, but it works for me. Number 5 today. Millions of traders will be devastated. Why? After nearly 4 decades in Congress, Nancy Pelosi has announced that she won't seek re-election. Now, there is no word on what her husband, stock savant Paul Pelosi, will do. All joshing aside, her legacy is potentially at risk, given Paul Pelosi's seemingly infallible timing when it comes to stock trades that often seem perfectly synced with Capitol Hill's calendar. And that's terribly unfortunate. Paul was apparently so good that an entire cottage industry has sprung up around so-called Pelosi trades. There are ETFs, watch lists, Discord servers, even TikTok channels that track every move that Pelosi's make, as if front-running Congress were a legitimate investment strategy. Now, I can only shake my head by all this stuff, right? You know something is seriously out of whack when retail traders start mimicking political portfolios. Now, my POV, it's long past time for serious reform. Lawmakers, I don't care what party, what side of the aisle, lawmakers should not be allowed to trade individual stocks, period, full stop. And violators, they should face unflinching criminal prosecution, not a slap on the wrist. Here's an investing tip, by the way, in this department. Sounds really obvious, but it's not. Follow transparency, not hallway whispers. All right, today's bottom line, I think, is especially appropriate, but the financial market is the only market on earth where shoppers fear sale. You got this, I promise. As always, let's make it a great day. Thanks for watching. I'll see you tomorrow. Cheers.